Something is breaking in real time, and I don't mean the usual market noise. I mean the foundation of global trade itself. Today, we're covering a lot. The Strait of Hormuz is effectively shut down, and with it, 20% of the world's oil supply has gone dark. Insurance companies have pulled coverage. Qatar has halted LNG exports. Europe's gas prices have spiked over 40% in days. We'll talk about why oil markets might actually be heading toward a structural glut despite all of this. Yes, that contradiction is real. Silver's bull run is far from over, and the gold-to-silver ratio tells a story most analysts are ignoring. Private credit. The shadow lending market that Goldman Sachs just called a ticking time bomb. And gold? Up 21% this year alone. The so-called big enchilada of US debt is the engine behind that rally, and it's not slowing down. If this is the kind of analysis that keeps you ahead of the curve, smash that like button and subscribe. It takes 2 seconds, and it genuinely helps this channel reach more people who need to hear this. Let's get into it. So let's start where the world changed. February 28th, the United States and Israel launched coordinated military strikes against Iran, targets in Tehran, air defense systems, nuclear facilities. The immediate market reaction was predictable. Oil spiked, equities wobbled. But here's the part that matters far more than any single day of price action. Iran responded by threatening to block the Strait of Hormuz. And they didn't just threaten it. Within 48 hours, commercial shipping insurers began withdrawing coverage for vessels transiting the strait. Think about that for a second. It's not a government sanction. It's not a UN resolution. It's the invisible hand of the insurance market saying, we will not underwrite this risk. And when Lloyd's of London won't cover your tanker doesn't sail. 20% of the world's daily oil shipments pass through that choke point. Qatar, one of the largest LNG exporters on Earth, suspended shipments. European natural gas prices surged between 37 and 45% almost overnight, and this is happening in March. Imagine if this had hit in November, with European storage levels already declining. What we're watching is not just a military conflict, it's the unraveling of a model. The entire post-World War II free trade architecture was built on the assumption that critical choke points, Hormuz, Malacca, Suez, would remain open, that navies would guarantee passage, that insurance markets would function. Every single one of those assumptions is now under stress. And when the model breaks, it doesn't break gradually. It breaks all at once. The billions of dollars that flow through that strait every single day are now priced differently. Risk premiums are surging, and the ripple effects are only beginning. Now here's where it gets genuinely interesting and contradictory, because while Hormuz is choking global oil flows, the structural picture for crude is actually bearish. Bloomberg's latest analysis projects a classic supply peak. The Western Hemisphere alone, think U.S. shale, Canadian oil sands, Brazilian pre-salt, Guyana, has added roughly 8 million barrels per day of capacity above current demand. The December Brent futures contract is pricing at around $58 heading into the U.S. midterm elections. That's not a typo. $58 in a world where Hormuz is blocked. What does that tell us? It tells us the market is doing two things simultaneously. In the short term, it's panicking over supply disruptions. In the medium term, it knows there's a structural oversupply problem that no amount of geopolitical theater can fix. The shale revolution fundamentally changed the energy map. America is no longer dependent on Middle Eastern oil the way it was in 2003 or even 2014, but Europe absolutely still is. And Asia, China, Japan, South Korea is extremely exposed. So what we're really watching is a bifurcation. The US can weather this storm. Europe and Asia cannot. And that divergence is going to show up in currencies, in bond markets, in trade balances. It's already showing up. Let me shift to something that's been quietly building underneath all of this. Silver. The bull market in silver is far from over, and the people calling the top are going to be embarrassed. The gold to silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has been elevated for years. Historically, when gold enters a sustained bull run, silver follows with a lag and then outperforms. We're entering that phase now. The ratio is compressing, and if history is any guide, it has a long way to fall. Some analysts are floating 3-digit silver prices. The $3,500 gold target gets the headlines, sure, but silver at $100 or $120, that's where the real percentage gains will come from. Am I fully convinced we'll get there? Honestly, I carry some skepticism about the most extreme targets, but the trend is intact. The fundamentals, industrial demand from solar, electronics, military applications, combined with constrained mine supply, support a sustained move higher. And here's the thing about silver that most commentators miss. Silver is both a monetary metal and an industrial metal. When you get a monetary crisis and an industrial shortage at the same time, which is exactly what's developing, silver doesn't just go up. It reprices entirely. Now, speaking of things that could break the system, let's talk about private credit. Goldman Sachs just released a report that should be making a lot more noise than it is. The private credit market, essentially non-bank lending to mid-sized companies, has exploded in size over the past decade. We're talking trillions of dollars in loans that exist outside the regulated banking system. Goldman's warning is straightforward. Years of easy money created a prolonged credit cycle. During that cycle, lending standards deteriorated. Covenants weakened, leverage ratios crept up, documentation got sloppy. And now, as the economy slows, the losses from this corner of finance will, and I'm quoting Goldman directly here, significantly exceed expectations. Let me translate that from Wall Street speak. It means they expect defaults at levels that will surprise even the people who are supposed to be watching this. The private credit market is the next subprime, not in structure. It's different instruments, different borrowers, but in dynamics, opaque, underregulated, over-leveraged, and enormous. The question isn't whether this blows up. The question is when and what it takes down with it. Because private credit is deeply interconnected with pension funds, insurance companies, and endowments. The contagion risk is real. And before I get to the big finish, let me take a quick detour through crypto. Bitcoin has formed what traders call a bullish flag pattern, with a target zone around $80,000 to $85,000. On the micro time frame, it looks constructive. But zoom out and the macro picture is far less friendly. A global liquidity contraction, rising real rates in certain economies, and institutional money rotating into hard assets like gold, none of that is particularly supportive for risk assets. Bitcoin may get its rally, but I wouldn't confuse a technical bounce with a fundamental trend change. If you're still watching, I know you value this kind of straight talk analysis. Take a moment to hit subscribe if you haven't already, and if you want to go a step further, consider supporting the channel through a super thanks or a sponsorship. Every bit of support keeps this operation independent. No corporate sponsors telling me what I can and can't say. That matters. All right, let's bring it home with the story that ties everything together. Gold. Up 21% since January 1st. That's not a trade. That's a statement. And the drivers are not going away. Start with central bank demand. The buying from China, India, Turkey, Poland, Singapore, it's not slowing down. These are sovereign institutions that are actively diversifying away from US dollar reserves. They're not doing it because they read a newsletter. They're doing it because they see the same numbers we see. Then add the interest rate environment. Rates are coming down. When real yields fall, the opportunity cost of holding gold disappears. Gold doesn't pay a dividend, but when bonds are yielding less than inflation, that argument becomes irrelevant. Then there's the dollar. The greenback has been weakening, and the structural pressures, trade deficits, fiscal deficits, the political instability that makes foreign holders nervous are intensifying, not easing. But here's the real driver, the one that sits underneath all of this: U.S. national debt. The so-called big enchilada. It's been building since the 1980s. It has never been meaningfully addressed, and now it sits at levels where the interest payments alone consume a significant chunk of federal revenue. This is not an abstract problem. This is the event that, when it reaches its inflection point, will fundamentally alter the value of the US dollar. And when that happens, not if, when, gold is the asset that reprices upward. Because gold is not just a hedge against inflation, it's a hedge against the failure of sovereign credibility. The Iranian conflict didn't start gold's rally, but it confirmed something the market already knew: traditional safe havens. Treasuries, the dollar, are no longer functioning the way they used to. Gold has effectively replaced US treasuries as the world's true safe haven, and every central banker on the planet is acting accordingly. 21% in 2 months, and we're just getting started. The debt problem isn't going away. The geopolitical instability isn't going away. The central bank buying isn't going away. If anything, each new crisis accelerates the trend. So the question I'll leave with today is this: the post-war financial architecture was built on cheap energy, open shipping lanes, and the unquestioned dominance of the US dollar. All three of those pillars are cracking simultaneously. What comes next isn't a correction, it's a restructuring, and the assets that perform in a restructuring are not the same ones that performed in the era that's ending. Something to sit with. Every episode of this show exists because of the community behind it. If this analysis helped you see something more clearly today, a like, a comment, a share, those small actions make a real difference. YouTube's algorithm is simple. Engagement tells it this content matters, and that pushes it to more people who are searching for honest, independent analysis. If you want to take it further, sponsorships and super thanks directly fund the research, the fact-checking, the hours spent verifying sources and connecting dots that mainstream outlets won't touch. This isn't a side project. This is a full commitment to delivering financial analysis that's accountable to the audience, not to advertisers or corporations. Drop your thoughts in the comments. I read them. I genuinely want to know what you're seeing in your corner of the world, what stories you think deserve more attention. This channel is a conversation, not a broadcast. Thank you for being here. Thank you for your trust. And I'll see you in the next one.